So this is an interesting story. You know, you've heard me stand up here and talk about inflation and, oh, the woes of inflation, and it's really scary and it's really bad. We have no inflation. I mean, if you look at the price of, and we'll talk about this in a second, healthcare and education, we've had inflation. Education is still inflating. Healthcare is actually, costs are declining. They started declining before the Affordable Care Act, but they are in decline, which is a positive. It's a very good thing. This, CPI, PCE, you can look at this, 12, 13, it's declining. So the worry is that we're actually in a deflationary period. We are not inflation, and we are fighting inflation, and we're worried about inflation. But the positive here is as long as it stays this low, the Fed can continue to stimulate. The issue becomes transitioning between stimulating the economy, and then how can they destimulate the economy or stop stimulating the economy fast enough so that we avoid inflation. And you know, we gotta give them some credit because they've done a pretty good job of managing that process. So these are all the pieces of inflation. You see the largest piece on the right side, this big brown box, is housing. And it goes from the largest piece to the smallest piece, okay? So you've got housing, transportation, food and beverage, medical care, education, communication. What is that? I cannot read it. Recreation, that's the best part. Apparel, and then other services, goods and services. So housing, huge part of this calculation. You know, and does anyone know what that housing calculation is? It's not the cost of houses. It's the cost of owner's equivalent rent. So as the price of housing goes up, the theory is rents will follow. Rents have to justify the cost of a house in your area. But we're seeing a lot of increase in that. But still, all in, you know, inflation is below that 2% mark and in decline over the last 2 years. Any questions about that? No. Here we have household wealth. You hear a lot in the media about how we've now eclipsed. We have more wealth in terms of our portfolios and our houses and our real estate portfolios than ever before. This is the 2007 peak. This is the blue line nominally, right? In dollar terms, we're way above where we were. But inflation adjusted, we're this green line on an individual basis. The red line is big picture, right? In a big picture basis, so that differential is there's some people get more, some people get a little bit less. The average household is the green line. So we're not even quite back to where we were, but we're definitely on the uptrend. So just in your lives, do you feel uptrend? Do you feel like you're doing better? Yeah? Does someone need to stand up and like jump around a little bit? Jeez. All right. So I looked at this today to sort of firm this up. Here we have this huge S&P rally. The S&P has gone up 30%. Earnings have gone up 7 or 8%. So that's wonderful for our stock portfolios, but it's not something we should expect lots and lots and lots of years. But the reason is, why do you think that is? Or why are the pundits projecting more earnings and faster growth? So last year, if we looked at this exact same chart, we would have seen that this 7.545 would have been 10, 8, 11, 13. Right? So what happens is they put out these big growth numbers, and then they slowly ratchet them back over time. So I looked today, and this 10%, this is an estimate for fourth quarter of 13. They're expecting 10% year over year growth. We're actually at about 7%, which is this. So that's of the companies that have reported mixed with the expectations on the companies that haven't. So we're already behind on this growth expectation, but we're still at 7% earnings growth. That's nothing. There's nothing wrong with that. And if we see a pickup, and everyone is claiming we're going to see a pickup, there's very few people out there that are saying, put this in parentheses, which makes me nervous, but there's very few people out there saying that we expect a slowdown. there's not an exact correlation between earnings and stocks going up, which is why you see a 30% return in the S&P and a 7% earnings growth, right? So that's possible because we are all together happier, right? We are excited about the market going up, so we're willing to pay more for the earnings that we see, and there's a point where that ends. We don't know where that point is. When people talk about a PE ratio, the price to earnings ratio, that's we're willing to pay a certain price for each dollar of earnings. And when we collectively get happier and we're willing to pay more and more and more for those earnings, then the stock price goes up faster than the earnings go up. The interesting part about what John just said is the self-fulfilling prophecy part. We get happy, we invest, prices go up, we sell a little bit of our stocks, we buy some more stuff, and when we buy more stuff, it drives earnings up a little bit more. So part of this stock price going up is us buying more, but who else is in the market? Who else buys stocks? Let's ask it this way. Who was the biggest purchaser of stocks last year? Somebody. The companies themselves. So one of the reasons we see earnings go up as much as we see is because companies, different studies, companies have been buying an enormous amount of stock back. Why would they do that now? Prices are high. Why didn't they do that in 2008 or 2009? It's so cheap to borrow. I mean, companies can float a bond that costs them nothing and take that money and buy equity back. And when they buy equity back, that means that their earnings, which haven't gone up any, or their revenues, which haven't gone up any, get spread across fewer shares. So earnings per share go up, which makes us excited, and we buy more, and then we make, so there's all these loops feeding into each other. Okay, that's enough of that. And then this year we had, this was last year, Europe did well. And remember, a year and a half ago it was a disaster and was going to fall off the face of the earth. France just printed a negative manufacturing report. Germany is actually floating at a 50, which is just barely above, with growth in their manufacturing sector. So we're not out of the woods there, but these markets would have you believe that we are out of the woods. And this is why they've done that. They've basically taken a page from the Fed. They've said, in 2008, 2009, they lowered rates to 1%. We lowered it to 0, and we grew like gangbusters. So now they've ticked it down, and they're basically where we are. And slowly, certainly, they're going to come back up. And this is one of the challenges is we had a global flood of liquidity, and that boosted all our asset returns, and it's wonderful, and we've enjoyed it. And now we have a global pulling out. They're not going to do this quickly. They're going to do this slowly. This is why it's going to start with a taper, why we're expecting rates to go up in 2016, 2017 is what they're talking about. So it's going to be very slow, but it's something to be aware of. China slowed, and we just got the latest print for China's growth, 7.4. So they went from, right here, they went from 12, 12.5, and then slowly. This was intentional, right? They did this on purpose, and I've said this so many times up here, it's sort of like a broken record. They're slowing their economy down on purpose because it was so hot. And now, now the dollar's going to go up in value, and it's going to mess with a bunch of emerging market currencies. They're going to have a really hard time when the dollar starts getting stronger. All right, we're going to watch this. Everyone remember this commercial?
I've had my ups and downs, my fair share of bumpy roads and heavy winds. That's what made me what I am today. Now I stand here before you. What you see is a body crafted to perfection, a pair of legs engineered to defy the laws of physics, and a mindset to master the most epic of splits.
Who can say where the road goes, where the day flows, only time? And who can say if your love grows as your heart shows, only time?
Don't try this at home. So what's the point of that? Why is that in this? Why is that in this presentation? Stability, balance. So there's all these things happening, emerging markets problems, weaknesses in currencies, the S&P's up 30%, the Fed's doing its thing, China's slowing down. So how do you battle that when you invest? So the only thing that's ever worked throughout history consistently is the three things that we preach over and over and over and over again. And this is not my research, this is just something we've adopted and we've been doing it for years. Diversification, asset allocation, rebalancing. Occasionally we think we have an idea and we change a portfolio, and occasionally we're right and occasionally we're wrong. But if you do those three things, diversification, asset allocation, and rebalancing, you end up far ahead of everybody. But it's not in a straight line. So here's what we're watching in 2014. This should actually go pretty quickly. The Fed exit, very, very important. We've already seen, you see today's the black line, 1 month ago is the gray line, 1 year ago is the line you can't really see. And this is an increasing yield curve. So the 10-year the yield on the 10-year has gone up, the value of those 10-year bonds have gone down. That's a mathematical relationship. It's likely that that continues. So this was the currency we talked about. These are the fragile five: Turkish, Brazilian, Indonesian, Indian. Well, that's only 4. Every time I do this, I look up and I miss one. I missed one. Okay, so we talked about this. We talked about this earlier. This is the chart that has the bump that happens in May. So in May, this is May, June. Our equities lost money. Our bonds lost money. But right about there, you see things kind of stabilize. But you started hearing about the great rotation. People went, oh my goodness, my bonds lost more than my stocks. That's terrifying. The media is telling me that this is how it's going to go for the foreseeable future. I'm going to start selling bonds and buying stocks. This is the great rotation. Maybe it's just begun. But here's the reason we keep bonds in the portfolio. A bad bond market is nothing at all like a bad stock market, right? Bond market, horrible bond market, you lose 4%, 5% that year. Horrible equity market, you lose 50% that year, okay? So we keep bonds in there as a ballast for the for the big hit. This is not prediction. We don't try to predict, but just in case it happens, we have bonds in the portfolio. The bonds are less interest rate sensitive. They're more credit sensitive, which is a different set of risks, but that's how we moderate the Fed exit risk. So this is where we are in PE. This is backward-looking PE. We don't have a really high PE. We have kind of an average, maybe a little bit on the high side PE. But when you look at the long-term averages, this is for the last 14 years. But if you look at long-term averages, we have a pretty high PE. But it depends on what time frame you look at. And valuation is really, at this point, anyone's guess. Depends a lot on what earnings do. But it doesn't actually look like we've exploded on the upside. So this you see the white line next to this blue line? Can you see that from where you are? You can't see it at all. Okay, so the white line in every single case except healthcare and telecom services, the white line is higher. What this is showing us is what I talked about earlier. The expectations have changed from September of last year to today. They have come down across the board except for healthcare and telecom services. So all the earnings expectations are being reduced. Not that they're going to be negative, but the expectations are being reduced. Politics. Got to talk about it. Today's a special day. By and large, we all want to replace our politicians. And this has gotten worse and worse and worse and worse over time. So we have this, who's happy with their politicians going down, who's not happy going up. And do you think that'll change anything? No, doubt it. Another thing, geopolitical tension, right? Whatever you're doing, don't cross the red line. Thankfully, it's just a 3-point line. Okay, so pardon for those of you who have religion issue, pardon the context. But I think that as we're successful in life, I think it's real important to keep our eyes open and do whatever we can to help someone that's not. And so this kind of talks about it. And I love this, so I just want to share it.
I'm going to tell you a story from my highway patrol days. Let's simply call this my Christmas Eve. The hour is late, should go to bed, near midnight I believe. But memories keep me wide awake this snowy Christmas Eve. Yes, memories of my kids moved on, each has their separate life. And how the holidays have changed since angels took my wife. The toys, the food, the Christmas cheer. My wife would bear the load because I would work most holidays, state trooper on the road. Just sitting in my easy chair, so many years retired, I reminisce on times gone by and all that has transpired. Of all the many happenings that seemed to come to light, a multitude of them occurred right on this very night. A drunken woman in Iraq who died on Christmas Eve leaves memories of a tragic case most people can't believe. I had to drive to where she lived to tell her next of kin. Found the rundown mobile home she had been living in. The person answering the door, I still recall today, a little girl about 4 years old. She said, "I'm Sue McKay." I asked her if her dad was home and felt the longest pause. She said, "My daddy ran away." "You must be Santa Claus. My mommy said you'd come tonight if I just stayed in bed and bring a pretty doll for me." It's what my mommy said. I broke the law that Christmas Eve, did not call child's care. They'd merely put her in a room, and that I couldn't bear. I picked her up and took her home. My wife tucked her in bed and wrapped a pretty doll for her, just like her mommy said. Adopted by a loving home, and soon they moved away. I won't forget that Christmas Eve and little Sue McKay. Another bitter Christmas Eve, a blizzard to behold. Had left a family in the ditch, just trapped there in the cold. By grace of God, I spotted them all cold and gaunt with fright, drove them to a motel room to safely spend the night. One Christmas Eve, a homeless man, shivering and wet, was trying hard to get a ride I'm sure he'd never get. I picked him up and drove him to a diner on the hill to warm his bones and left him with a $5 bill. Strange how when you're all alone with memories you recall, you think of everything you've done. Was it worth it all? I think about my God, my job, my children, and my wife. Would I do it all the same? Could I relive my life? Then comes a knock upon my door. This late, who could it be? A neighbor? Or has Santa Claus come to visit me? The figure standing in the cold gives me a sudden fright. A trooper with that solemn look. Dear God, who's died tonight? I'm flashing back through bygone years and how I'd often stood on someone's porch to bring them news, and it was never good. Is this how life gets back at me? For misery I've induced, where pain I've caused some other folks has now come home to roost. But looking in the trooper's eyes, my mind is in a whirl. I see a pleasant countenance. The trooper is a girl. She smiled and reached to shake my hand, and silence wasn't broke until a tear rolled down her cheek, and then she softly spoke. "I'm sure you don't remember me, but thought I'd stop and say, God bless you on this Christmas Eve. I'm Trooper Sue McKay."
Thank you.